Today, we're diving deep into Compass Pathways, a company that is right on the bleeding edge of mental health care. They're betting the entire farm on one single, really revolutionary idea. So the big question for us as investors is simple. Is this a visionary play on the future of medicine, or is it a high-stakes gamble with just way too much risk? Let's find out.
To really get a handle on the opportunity here, you first have to understand the scale of the problem. Look at this number, $232 billion. That's the annual economic cost of just one condition, PTSD, in the United States alone. It's just a staggering figure, and it points to a desperate need for better treatments for millions of people who just aren't getting help from current therapies. And that is the exact void that Compass is trying to fill.
All right, here's our game plan. We're going to start with the science. Then we'll really scrutinize the business and all its risks. After that, we'll run a financial health check, tackle the tricky question of valuation, and finally, I'll give you our verdict and even offer an alternative way to invest in this space.
So the whole story behind Compass, the reason it even exists, starts with a group of patients who are so often left behind, those with what's called treatment-resistant depression, or TRD. We're talking about millions of people who have tried at least 2 standard antidepressants, and they failed. They're left with very few options.
And this is where Compass comes in. They think they have an answer. Their main drug candidate is called COMP360. And it's not just a pill, it's a proprietary synthesized version of psilocybin, the active compound in magic mushrooms. But it's given together with specialized psychological support from a trained therapist.
So how does the stuff actually work? Well, unlike traditional antidepressants, psilocybin goes after these very specific serotonin receptors in the brain. And what this seems to do is trigger something scientists call neuroplasticity, which is just the brain's amazing ability to rewire itself. It can kind of break up these rigid, negative thought patterns, creating this unique window of opportunity where therapy can suddenly become way, way more effective.
Now, a revolutionary idea is one thing, but building a business that can last is a whole other story. So let's dig into the company's competitive advantages, what investors call its moat, and also look at the very real dangers that are lying in wait.
You hear this term, moat, thrown around all the time in investing. So what does it actually mean? Well, think of it just like the ditch around a medieval castle. It's that durable advantage that protects a company's profits from getting eaten up by competitors over the long haul. A wide moat is a really good sign of a high-quality business. So what does the Compass moat look like? Well, it's really built on 4 main pillars. First, and this is a big one, patents. Their core IP is locked down until around 2038. That is a long, long runway. Second, they have a clinical head start. They're already in a very advanced phase 3 program. Now, this is the final, biggest, most expensive stage of testing before you can even ask for approval. It's the absolute make-or-break moment. Third, there's potential to expand. They've already got positive data in PTSD, which suggests this isn't a one-trick pony. And finally, some good old-fashioned brand protection through trademarks.
Now, since Compass isn't actually making any money yet, its entire valuation is based on what it could make in the future. The biggest prize, by far, is treatment-resistant depression. But that positive data in PTSD, that opens up another huge market. And the company's also looking into using it for anorexia nervosa, which gives them multiple shots on goal for future growth.
But, and this is a huge but, with that great potential comes some really massive risks. The biggest one is clinical trial failure. If that phase 3 data comes back negative, the company's main asset could become worthless literally overnight. Then you've got the regulatory hurdles with the FDA, which is never easy. And importantly, the company has already hit a significant setback. They've announced delays in the timeline for that critical phase 3 program. That's not what you want to see.
Okay, so with the business model and those big risks in mind, let's turn to the financials. For a company that isn't selling a single thing yet, we have to look beyond the usual numbers to figure out how healthy it is. This really is the key question for any biotech company that's still in the research phase. If there's no income, what numbers could possibly matter? Well, the answer is you have to focus on 2 things, solvency and spending. How much debt do they have, and how fast are they burning through cash? Let's pull up the scorecard. You can see revenue and gross margin are not applicable, just ignore those for now. What we really care about is this debt-to-equity ratio. It's a very healthy 0.21, which means they are not loaded up with debt. But the most important number on this entire slide is free cash flow, negative $119 million. That's the company's annual burn rate. It's the cash they're lighting on fire every year to fund all this research. So how long can they keep that fire going? This brings us to what might be the most crucial metric of all,
the cash runway. And here's the key takeaway. Compass has enough cash in the bank to fund its operations all the way through its next huge data release in the second half of 2026. That is absolutely critical. It means they are funded past their most important milestone.
And that brings us to the ultimate question of valuation. Is buying this stock today a genius move, or is it just a reckless gamble? It really all comes down to how you weigh that massive potential reward against the very real possibility of total failure.
You know, the argument here is about as black and white as it gets. The bull case is super simple. If COMP360 gets approved, it could become a blockbuster drug, disrupting a gigantic market with patent protection all the way to 2038. The upside would be just enormous. The bear case is just as simple. If that phase 3 trial fails, the stock could lose almost all of its value overnight. It is truly an all-or-nothing proposition.
And let's say they do it. Let's say the trial is a massive success and they get approval. There's still another huge mountain to climb: getting paid. The single biggest long-term risk here is reimbursement. Compass will have to convince insurance companies and government healthcare systems to actually pay for this new therapy, and trust me, that is going to be a huge, huge battle.
Okay, we've looked at the science, the business, the financials, and the valuation. It is time to put it all together and issue our final verdict.
So let's just boil it all down one last time. The strongest argument for buying this stock is that combination of a huge unmet medical need with a truly novel patent-protected solution. The biggest risk against it is the binary all-or-nothing nature of that clinical trial. It's that simple.
Taking absolutely everything into account, our official recommendation is a speculative buy.
And let me be extremely clear about this. Speculative is the most important word there. This is a high-risk, high-reward investment that is only suitable for investors who can truly stomach that risk. You know, giving you a price target today would be pure guesswork. The company's entire value, every penny, hinges on that phase 3 data, which we aren't even going to see until 2026.
Now, if that all-or-nothing bet is just too much for you, but you're still interested in this new frontier of mental health care, there are other ways to invest. So let's take a look at the alternative play.
Our sources point to a couple of interesting alternatives. If you want a more defensive, safer approach, you could look at Johnson & Johnson. They already have an approved therapy for TRD on the market, plus they're a massive, diversified healthcare giant. A second option is a company called Neurocrine Biosciences. They also work on depression treatments, but they have a much broader pipeline of drugs, which reduces that single point of failure risk that you see with Compass.
So there you have it. Compass Pathways is a fascinating but deeply polarizing company. It represents a potential paradigm shift in how we treat mental health, but its investment case is truly balanced on a knife's edge. Now, we want to hear from you. What companies should we put under the microscope next? Let us know in the comments below.